Well, facetiously, when I saw the core CPI come in flat, I thought, oh, Kevin Warsh is the most successful Fed chair ever. He's done it in a matter of weeks. He's solved for the inflation challenge in play. Except that, to your point, what we're seeing this month is entirely the energy drag explaining the headline decline. And there's enough going on in core CPI to tell us that these are probably some volatile components like motor vehicle insurance and wireless telephones. Those have dragged on core CPI. Underneath the surface, I am still concerned. And firstly, I don't know that we should be saying inflation is totally solved when core inflation in America is still at 2.6%. We are over 5 years of inflation above target, and we still have some pretty serious issues in the areas that matter most to consumers, like food, which is up 3% and still likely to accelerate ahead, and an extremely tight labor market that reminds me of the good old-fashioned demand-led inflation, which is still in the system as well. So I think two things can be true. We can celebrate that we've had some reprieve here this month in many areas of the report. This is good news for Chair Warsh as he heads into testimony, but it is too early to take our eye off the ball.
Francis, would I get thrown out of the Federal Reserve if I walked in and said, you know what, in today's world order, 2.5% core CPI, that's fine. I mean, in a world where there's globalization is going by the highway here and it's all, every man for himself, costs are going to be higher. That's just the way it is. What happens then?
Would you get thrown out? No, but you'd probably be relegated to the basement with a few other colleagues who share the view, and you'd have to be really quiet about it. I suspect that the way we have to think about inflation now is really comes down to this idea of what is supply-led inflation and what is demand-led inflation. And the San Francisco Fed actually breaks this out. And what they find right now is that it's about half supply given. And that's everything from AI to tariffs to the Strait of Hormuz coming through and created blockages. But half of it is demand-led. And this is the area that the Federal Reserve can control and should control. So while we continue to focus on these big structural trends that are meaningful to price levels and price growth, I think this Federal Reserve is really going to struggle more with the old-fashioned types of inflation. And that's because, Tom, as you've highlighted many times this morning, nominal growth is very strong in America. The labor market is extraordinarily tight. There is a massive infrastructure build coming out. It is the Gilded Age 2.0. And you have an exceptionally wealthy top 1% consumer. Those are the types of things that drive demand-led inflation. So the Fed can be excused, and all central banks globally can be excused for wanting to look through supply-led inflation that maybe brings us above 2%, but they have to stay focused on demand side. And that's where my concern in the second half of the year is, much more so than are we seeing energy coming up or down in a month to month.
So I'm looking at the work function here, still looking for almost 2 rate hikes this year. Does that seem reasonable to you?
We have the Fed on hold, and of course it's natural to say, okay, well, what does this number mean for the Fed? But I look at this number now from a different lens, which is what does this inflation mean for the consumer and tell us about the consumer? Because at the end of the day, what will matter for most businesses, for anyone picking stocks, right, for those who are trying to serve, is what is this telling us about the consumer? It's telling us that the consumer is not struggling under the same gasoline prices that they were last month. It's telling us there are certain items that they'll get some reprieve on, but it's still telling us that prices are too high for most consumers. And when you combine the CPI number with the fact that we no longer have tax refunds, that we have seen savings eroded, this is a consumer that may have had some reprieve now, but if we see another price shock in the second half of the year, whether energy prices rise again, whether food prices rise or reprieve, I don't believe this is a consumer that can withstand that, and you'll see pricing powers eroded.
Francis, one final question. I think just to get us, through the year and on into I haven't said this yet. 2027?
No.
Are you ready for that?
Please. No.
I mean, Francis, I look at all the uncertainties, all the different threads and narratives. Off your desk, is there a confidence to be in the markets given the economic confusion?
It's not too early for 2027. We just had a meeting of when we were going to put out our 2027 outlook. And it's July. And we have to contribute forecasts for 2027. And when we look into 2027, what we see is it is still really hard to bet against the American economy. And that is because of the structural support coming from non-residential builds. That's infrastructure. You still have a wealthy top consumer, and there's a lot of government money inside. There's productivity growth that is helping the American economy stay at or above 2% growth for the next 12 to 18 months. And as we head into 2027, though, I think what will be the biggest challenge for markets to digest is that you're going to get what I'm calling fortuitous math, which is base effects are going to bring inflation in the second quarter down next year into as low as 1.3%.
Yeah.
Core inflation will not be that low. It'll be in the mid to high twos, but we're going to have to digest some pretty serious base effects. But if you combine those two stories together, as I continue to say, it's real hard to bet against the U.S. economy.
Francis, people are slowing down on I-80 right now across America. Do you know how much our listeners hate base effects? They go to the grocery store, and the base effect is, when did I pay $7 for oranges? They used to be $3.
Exactly.
Or hamburgers.
Prices are up 30% in 5 years. Consumers care way less about year over years. They don't care about what Fed Warsh is going to do. They care about the real economy. And that's what numbers like this morning's CPI tell us. They tell us there's some short-term reprieve, but prices are too high, and consumers, the mass consumer, is still struggling under the weight of higher prices and the cost of living.